Hi, good afternoon and a warm welcome to everyone in today's edition of Business and Banking Dialogue. Money, as you know, is an essential foundation for a free and prosperous society. In this edition of Business and Banking, discuss with Mr. Udayan Goyal the future of money. Mr. Goyal has immense finance and investment. He has a global perspective, including India. Mr. Goyal is based out of London and is a co-founder of Apis and Anthis Group, the first specialist global investor in the fintech companies. My name is KK. I'm the host for today's show, which is live across EPS channel, Facebook, Twitter, and YouTube. Thank you, participants. Thank you for such a large participation across these channels. It bears testimony to the fact that these discussions are interesting, meaningful, and informative to you. Good morning, Udayan.
Good morning, KK. How are you?
I'm good. Thanks for coming. Udayan, we will be discussing the future of money, topic of great importance as things are going to change in the new world post-COVID. So the new normal will be different with money that we see in the days to come. Talking of money, there was this big news about China opening up for foreign companies to the tune of $40 billion. That's massive, isn't it, Udayan?
Yeah, I think the Chinese, I think it was over the weekend, made an announcement that they were opening up the financial market, so financial institution market to foreign investors, which is really the first time they've done that. I mean, that's basically following a few moves that you might have seen in the press. So one is that they gave American Express the ability to clear transactions on the Chinese mainland, which is something they weren't able to do that before. And I think they'd also done that previously with MasterCard. So they're essentially allowing foreign companies to come in to invest in financial services, which was before a kind of restricted sector in China. And what's interesting is I think this is a little bit of geopolitics as much as anything else. You know, the US is increasingly closing the doors to Chinese investors coming into many of their sectors, including the financial market. And so I think what's happening here is very much a global economic power struggle that's going on between the two. Because obviously, you know, there are rising tensions over COVID. I think what the Chinese are doing are essentially opening it up as a way of mitigating some of the pressure that they're feeling from the global community around what's happened around COVID, and certainly from the United States. And I think the Chinese are also taking advantage of US weakness right now, because as you know, the US has some serious domestic, social, and political economic issues right now. And basically they're taking advantage of that by opening this market up and allowing investment to come in. Keep in mind that, you know, the main overall globally, you know, the US debt or US government debt is typically something that most central banks hold. And that's what makes the US dollar a reserve currency. I think over time, you know, if with the Chinese opening up, I could definitely see many governments around the world and many reserve banks starting to diversify holdings into Chinese holdings, you know, and therefore dilute the effect of the US dollar as a reserve currency. So this is really quite interesting. And I would say the other thing, of course, is that the Chinese have always had some issues with the traditional financial services sector. And so, you know, by increasing the supply side, they're allowing more and more work to be done to create a little bit more competition on the supply side. However, keep in mind that China is probably the most advanced fintech market in the world. And we've talked about this in previous discussions. So the large Chinese tech companies, the Baidu, Alibaba, Tencent have done a lot of work, very much dominate a lot of the retail side of financial services. So I think it's very hard for foreign incumbents to come in and compete effectively in a market. And I'm sure that thought had not escaped the Chinese regulators and the Chinese government when they opened this up, knowing that they had a very, very strong incumbent there, which would be hard to displace. So it's been quite interesting, I would say.
Absolutely. I think this, the tug of war is going to be very interesting in the days to come with what's the kind of shape the world is going to take and how the world financial market is going to change. So let's move on with our discussions. We have shifted, we have witnessed a big shift in the use of money. The shift from paper-based currency to electronic money. This is a massive shift that has happened. And by and large, people have made that movement, though a large part of the population across the globe still not in the main financial services. But to move from paper to electronic, that is to mobile money, has coincided with the changes in the way business is being done right now. So according to you, what next? What are the new forms of money that you see coming up in the near future?
Well, I mean, new forms. I think it's interesting, Kiki. You use the word form factor. I think that's right. I think money is money. We will continue to have some sort, shape, form of money or value exchange, or tokenized value exchange, however you want to talk about it, in the future. The form factor, as you say, is starting to change, and it's starting to change because people are looking for efficiencies in terms of moving money around. So, traditionally with physical cash, there was significant friction in the value exchange because you had to be physically present with the other person to do a transaction, so to hand over the cash, etc. Then what we did was we sort of tokenized that cash by making it electronic and putting it into bank accounts. So that was kind of the first version of digital cash. But even there, moving money around, particularly cross border, wasn't frictionless. It cost. It cost because we had a centralized ledger system that was central bank driven down to the individual banks, down to the people. So if I even in a rupee environment, just from a rupee to rupee transaction, unless you happen to be in the same bank and the person you're transacting with, you have to go through some form of clearing facility in between, and that infrastructure costs money, and obviously that creates friction. Now, over time, because we've increased transaction volumes and because the cost of the network is essentially fixed, the marginal cost of each incremental transaction has dropped dramatically. And in fact, nobody has done it better, I would say, than in India with UPI, which is an incredibly efficient and an incredibly effective system that allows you to move money around at very, very minimal cost. So that's not a surprise. That's not the same in other parts of the world. And it's certainly when you start to look at cross-border moving of money, it becomes more and more expensive. Now, as you've seen, we've had a few years ago this concept of blockchain and distributed ledger technologies come in. And what blockchain has done is create an efficiency by removing the need for a centralized ledger and moving to a distributed ledger, and therefore allowing people to transact local as opposed to having to be online on a wider network to do the central ledger book entries. And so what that does is you have a technology there that can create massive efficiencies in terms of moving money around. And so that's why we're starting to see many central banks now think about how do they evolve the first generation of digitization of physical cash, which is what they had, into the next generation of digitization of physical cash by adopting the underlying blockchain technology and tokenizing their home currency. The Bank of China, the PRC Bank of China, was really the first to do this. You might have read today, the Korean Central Bank has just set up a working legal group that is looking into creating, in inverted commas, stable coin based on their currency. And many other central banks, including the Bank of England, have working groups in this, because they recognize that there's an opportunity to remove the friction of moving money around by using these technologies. So I think we will see technology evolution in the form factor. Now we have to contrast that to the concept of cryptocurrency itself. So cryptocurrency, which is what you read, Bitcoin and Ethereum and some of these other types of coins, or even the Facebook proposed stable coin, all of these are currencies in their own right. They're not fiat currencies in the traditional sense of the word, which are issued by a central bank and therefore subject to monetary policy. They're currencies that exist as a sort of exchange of value, a little bit like gold, to be, is a good analogy. I think governments are much more reticent to embrace those types of currencies for many reasons. One of the main reasons is that they lose control of monetary policy at that point, because they have the inability to issue currency when needed, to control inflation and things like that. And you see that actually today in COVID. You can see how the Fed in the US is printing trillions of dollars of of new cash to be able to prop the stock market, and to be able to yesterday announce that they will now even buy corporate bonds. So really you start to see how governments use that, and they want to maintain that control. Now, is that a good thing? I'm not sure, because I don't know where we're going to go post COVID with some of this monetary easing and all this cash that's been created. But there's debates on either side. So that's some of the evolution, I would say.
Right. Yep. Thanks. So with the new shift, do we also see innovative ways of using trading in the way money changes hand from P2P, B2B, B2G? I mean, are there some new ways or innovative ways we will start using them?
Well, I mean, I think once you get into distributed ledger technology and tokenizing cash, so I think JP Morgan, for example, created a stable coin which is based on the US dollar. So that all that is that this is JP Morgan will hold, for every one coin, they'll hold one US dollar, and it's interchangeable. Then what what you have is essentially a store of value that you can move around within the network without the usual frictional cost of moving the US dollar, which requires banks and correspondent banks and ultimately the Fed to do clearing. So by doing that, you take that frictional cost. Now you can build very interesting business models around that. So probably the most interesting in my mind is trade and commodity finance, right? Because you can actually see a situation where you can replace the traditional letter of credit architecture of trade and commodity finance with stable coins, because you can do a peer-to-peer transaction between the buyer and the seller. You can hold those coins in escrow subject to the delivery of the goods, and all of that can be done on a pretty standard rules-based system. And by doing that, you really do remove a lot of the frictional cost of issuing letters of credit, the people that are involved, moving those letters of credit around, the mutual recognition between the send bank and the receive bank. There's a lot of that. Now, of course, the quid pro quo of that is that banks make less money, because banks make money out of friction. And once you remove the friction, their ability to make money starts to disappear very rapidly, because they essentially have to find new ways of making money. And ultimately, they have to fall back to what banks really should be doing, which is managing risk, rather than making money on friction, which is what they've been so used to doing. So there has been some resistance in some of these technologies as a result, because banks like to maintain the status quo. And obviously, there's very significant revenues involved in this. But over time, I think you'll find that the adoption of these technologies will create these interesting business models, whether it's at the trade and commodity finance level, as you mentioned, at the peer-to-peer level, where the ability to, let's say, do money transfer can be done more on a peer-to-peer basis than go through these very expensive money transfer companies and networks, whether it's actually for governments to take tax payments, because it could be a much easier way to take tax payments. So yeah, so there are going to be lots of interesting new business models, and there are already lots of business models evolving right now.
Yeah, true, very true. And thanks for that. In fact, I was going to ask you this query the next, that will that have an impact on banking? And you've already said that that's going to be a little tough for the banks, because, as you said, the banks make money out of the friction, and that's going to ease out in the days to come, perhaps. And so I think banks will have to innovate new ways of getting income and fees. So good to hear that. So ladies and gentlemen, we are continuing our discussion with them on the future of money. Meanwhile, while I continue with the discussion, could you please look at please put in your questions so that we are in a position to take the questions to Udayan. This topic is like so interesting, and which is very so topical. I'm sure lots of you have a lot of questions to ask. So please, start putting your questions much early than what you would otherwise do. Okay. So, Udayan, since the audience must have heard so much of digital money, they already heard a lot from you and from some other subject matter experts on digital money. So let's discuss on that point. So we use money, the storage value in a currency, correct? So if I have a 100 rupee note, I know that 100 rupee unit remains constant no matter what. Okay, no matter what happens, no matter where I go, that 100 rupee unit is still 100 rupees. Will the same hold with the digital money?
Well, I mean, it depends what, again, you have to bifurcate the definition of digital money, right? So, and the bifurcation needs to exist. So one is a cryptocurrency in its own right. So cryptocurrencies are things like Bitcoin and Ethereum and others. The other is a stable coin, which is based off a fiat currency. So I talked about the JP Morgan stable coin, for example, but there are many versions of the dollar coin, for example, and what the PRC is doing with the with the renminbi, the electronic renminbi, is exactly the same. Obviously, there is no difference in the latter in terms of storage of money, right?
Yeah.
What you used to store as a dollar it's merely the form factor is changed. Just like the form factor changes when you go to an ATM, put in your debit card or credit card, tap out 5,000 rupees, and out comes 5,000 rupees. So that money that was electronic sitting in your bank account has now become physical. The form factor has changed. So all we're doing here is changing the form factor from an electronic central ledger style currency. So the 5,000 rupees being stored with your bank, which itself has an account with the Reserve Bank of India. And therefore, that's how you know the money is there, to a stable coin, which is backed, let's say, by the rupee, and basically is exactly the same. So so there's no difference. It's just the form factor. When you go into cryptocurrency, it's a little bit different, because cryptocurrency is a little bit like gold. How do you know what the price of gold is at any time? It is a function of demand and supply. So gold is traded in many markets, and if you have excess demand relative to supply at a given time, there's upward price pressure, and if you have excess supply relative to demand, or people selling into the market, there's downward pressure. And cryptocurrency is exactly the same. The issue, of course, is that people understand gold more, and people understand how, the fact that gold is a finite supply of gold. It's the amount of gold that's being mined out of the ground at any given time is what's adding to the global supply. And that is its own form of monetary easing into the gold ecosystem. With crypto, for example, Bitcoin, it's also mined, to use the same terminology, at a certain rate, and it's being eased into the ecosystem, and therefore, again, it's a known finite commodity. The issue today, of course, is that the relative size of the crypto market, the cryptocurrency market, that is, to the fiat currency market is very, very small. So you can have very significant currency volatility in that market. And so your point about storage of value, of course, you can store value in a cryptocurrency as well. The issue is that you struggle a little bit because you have these very, very high volatility or price volatility. And you've certainly seen that even more over this crisis, because you've had wild swings off that. And really, for what a lot of commentators say, that for a commodity like that to be regarded as money, it really needs to retain its value over long periods. Unfortunately, in the crypto market, a 10 to 20% currency swing, a swing in value is pretty common. That's unlike most currency markets, where a 10% swing would be considered in some cases catastrophic if it was down. So therefore, a lot of people are still cautious on crypto as a storage of value. There's an increasing group of people who do it, and there's an increasing onus to do it because of the mistrust of fiat currencies as a result of this excessive monetary easing that we've seen through the COVID crisis. And even prior to that, because nobody controls cryptocurrencies, just like nobody really controls gold. So people really see that as an interesting anti-inflationary hedge against typical fiat currencies.
Yep. Thank you. Thank you. So just on a lighter note, do we have to carry our wallet with no physical currencies in the days to come? Is that what you're going to see?
I mean, I don't carry a wallet in London anymore myself. I don't carry any physical cash at all myself. I have 90% of the time, all I have is my phone, because I can actually do contactless payments straight from my phone into a contactless terminal. Post-COVID, many retailers actually here in London are stopping to accept cash anyway. They don't want to see cash. So you kind of have to have some form of contactless, which is your phone. I very occasionally have my wallet with me, but that's there because there's a very small proportion of retailers who don't have contactless terminals as yet, but that's changing rapidly. So I think the need to carry traditional wallets will disappear very, very quickly. And in fact, at some point, one may even not need to carry your phone or need the phone to make contactless payments, because, for example, India already has the right infrastructure to move directly to biometric payments, where you use your fingerprint to pay for things. It already has because of Aadhaar. So these sorts of things are going to evolve and evolve rather quickly.
Yeah, thank you. So, ladies and gentlemen, that's what you have. It's coming. A very interesting day is coming. You actually can go out without carrying your wallet. Isn't it a great transformation? These kind of transformations are very interesting and something we should look forward from a technology point of view. So excellent. So I continue my discussion with Udayan, and I look forward to getting questions from you. So Udayan, two things that often get discussed is cryptocurrency and blockchain. It's a combo, often discussed together. Cryptocurrency and blockchain as a combo. So I bring this topic as many in the audience are youngsters who have just started their career or in banks or some other financial industry, or finally a tech students planning to take up career in banking. Quite a few do come to in these shows. So please explain. Also tell us if this combo will get adopted in the mainstream as we go ahead with the digital currency.
So you're just saying the concept of cryptocurrency and blockchain. I think the underlying technology for cryptocurrencies is blockchain. That's a given. So that's the whole concept of distributed ledger technologies that I was talking about earlier. Digital currencies, as I mentioned to you before, it depends on the currency. So I said, the PRC bank in China is got a digital renminbi, which is based on blockchain technology. The Koreans are looking into it. The Bank of England is looking into it. So country by country, every reserve bank is going to look at creating a parallel currency that's based off blockchain, but is basically the same currency, just in a different form factor, and will use the blockchain protocol. And the blockchain, all the blockchain protocol does is go from a centralized ledger to a distributed ledger, which means it alleviates the need for an online network to be able to do the exchange of value, which obviously creates massive efficiencies.
Yeah, thank you. Thank you for your the talking about the technology that may come, and how other central banks are reviewing the use of technology for digital currency. So let's talk about CBDC, central bank digital currency. Um, so this is already, as Udayan has been talking, is under the consideration of many countries very actively now. It's all discussions in the boardroom of many central banks. So one of the problems for us, Udayan, is that price swings make headlines, but reduced volatility and the governance of central bank might also reassure individuals and merchants to adopt CBDC that have been hesitant to accept or use cryptocurrency today. That's one of the reasons why cryptocurrencies are not much used, because you never know the volatility. So is this possible that under CBDC, everything comes under the governance of the central bank or the government?
Absolutely, it's entirely possible to regulate the use of uh, cryptocurrencies. In fact, you need the central banks to regulate the use of cryptocurrencies if they are to be officially accepted currencies in a market for the sale of goods or others, right? You can't. Otherwise, what you're doing is you're going to have an issue with the acceptance of that currency. Now, as more and more people use it, I think by nature, it you know the adoption itself will reduce the volatility. Volatility swings are caused when when there are uh, gapping in the supply demand curve, right? Where you have sudden surges of supply and sudden surges of demand, and vice versa, right? That's what causes the price volatility. But if you have a consistent amount of demand and supply into a market, then price movements tend to be very gradual, which is what we have in the most liquid market in the world, which is our currency markets. So I think this is all related to adoption. I think as people will adopt, we will see less volatility. And if we have a functioning central bank digital currency, of course, that will be much more stable. And of course, it'll be much more stable if it's based on a fiat currency because of monetary easing and the ability to manipulate, or certainly somehow smooth out price fluctuations in that market. But I also see that for traditional cryptocurrencies as the adoption curve increases.
Okay, thanks, Sudhir. So, ladies and gentlemen, we are almost 30 minutes and passed into this discussion with Udayan. So, I look forward to your questions. Udayan, I have already an observation and a question. Okay, both together. The observation is that in India, UPI with a phone, AEPS without a phone are already stabilized. Hence, there is no need to carry a cash card and phone too. Hence, so that's an observation that he's making, that we already have something like a digital currency. So the question is, isn't digital currency nothing but dematerialized currency note? So any money deposit which is with the bank can we not consider as a digital currency?
Well, yes. I mean, that's just a semantics kind of nomenclature point, right? Yes, of course, money is today digital. Banks don't hold banknotes equivalent to the deposits that they have sitting in the bank. That's not the way not the way any monetary system works, right? It's the vast majority of money is held digitally at the central bank and then passed into the individual banks and then into the individual accounts in each country. So absolutely that it is a form of digital money. The difference between, as we said, this idea of CBDC, central bank digital currency, and traditional, what you would call digital currency, is the underlying technology used to move the money around. In CBDC, you're using blockchain technology, which is a distributed ledger technology. In the case of traditional digital money, as you would call it, the stuff that's sitting in your bank account with your bank, you are relying on a centralized ledger, which is ultimately held by the Reserve Bank that actually regulates that particular currency. So that's broadly the difference. And the latter creates the friction because there's a cost associated with changing the ledger every time the money moves. Now, to your point earlier about India and UPI, etc., absolutely, India has one of the most efficient systems in the world today to move money around from account to account because of UPI and IMPS and others, right? Because of these systems, it's highly efficient, which also means that the need to adopt a blockchain based infrastructure is less because it's already very efficient. So just because a new technology exists doesn't mean one has to adopt it. You have to have a use case, and the use case is to remove the cost out of the equation. And I think the need for India to do it anytime soon is not there. But as the world transitions to an infrastructure that embraces these types of currencies over time, I suspect it would make more sense.
Okay, thank you so much. So whoever asked the question, I hope you have got the answer to that, and I think very perfectly pointed out by Udayan. So as we know, the world is plunged into very difficult times, in times like never before. To respond to these difficult conditions, the governments around the world have started employing aggressive stimulus measures. Like even India has done that, ranging from sending checks of benefits to citizens directly and emergency rate cuts from most of the central bank. Where the problem lies is that the benefit transfers where is it used by the citizens? Where is it used more? These kind of benefit transfers is unknown because of the way we are sending the money. So there is an opinion that CBDC might just be the right solution to pinpoint which sectors need most of the benefit. Your thoughts on this, sir?
Which sectors need the most benefit
of the benefit? Yeah.
Well, I think anything that requires money to move large distances, as when I say large distances, I mean cross border.
Yeah.
Obviously, they're the ones that benefit the most because that's where the greatest friction is. So you have to think about where the greatest friction is, and that's where the greatest friction is. So as anything that's in the trade and commodity space benefits because in the global trade space benefits because that's where the greatest friction is. Anything in the travel space benefits because people are paying for, let's say, hotels across borders. Anywhere where you need to send money overseas, that there's a huge benefit to that. So that's where the greatest benefit is. It's really related to, as I said right at the beginning, the friction. Where's the greatest friction? And then when you remove that friction, you remove the cost. When you remove the cost, you have the greatest benefit. So I would say that's probably how to look at it.
True. Okay. That's the interesting observation. Let's move ahead. And since we are talking about digital currencies, let's look at the top 3 digital currencies that are making news. One, of course, is the POBC, CBDC. That's making the news, and it's already they are, I think, doing a test trial, etc. Fed's Libra, and perhaps Eurozone's Positive Money and Facebook currency also. So what is the progress in adoption of digital currency?
Well, I would say China is clearly the leader, the global leader in the central bank digital currency, or CBDC, as we've been talking about earlier.
Yeah.
I think that this virtual currency will really be the first global launch of a virtual currency globally. They've already done early trials with over 19 businesses altogether, including people like Starbucks and McDonald's within China, as an initial stage of the pilot. And there'll be a real use case for this. But interestingly enough, nobody will even notice the difference, right? Because the difference will only be noticed in how the money moves around. Because it's renminbi, it's the same thing. It's just the form factor, as I talked about, changing. And basically what that means is that today, what's interesting is that 96% of all transactions domestic transactions in China are processed by Alipay or WeChat Pay. This comes back to what I said before, right? That the Chinese domestic financial services market for retail is largely dominated by the Baidu, Alibaba, Tencent, right? And here, this is a great example of that. So once the digital currency starts to come in and becomes peer-to-peer, the dominance of the Alipay and WeChat Pay starts to wane a bit, because it'll start to move into this form factor. And once it moves to this form factor, it'll align one of the main objectives, I think, of the Chinese central government, which is to really centralize the vast majority of the financial activity onto a handful of financial platforms, including, in particularly in the rural areas where previously it was either cash based, so they didn't really have much acceptance. So, what they're going to do is, I think their plan is really to integrate this new version of the renminbi into the existing digital payment rails, so that people don't really notice any difference, but it gives the government more of an insight, because the nature of this currency into what's being used, what the cash is being used to, etc., which they weren't able to do before. But interesting enough, again, because the form factor, very few people will know the difference. So I think that's probably the first real global launch of the CBDC that we'll see in the future. Libra and Facebook stablecoin are a different take on the situation. It's a consortium structure where they've tried to build a very strong global consortium to create a cryptocurrency which isn't controlled by any single central bank, and that actually is problematic. And it's problematic because central banks don't like to cede control on monetary policy to an independent arm. And so as a result, I think there's been a lot of resistance to the launch of of Libra and the stablecoin, because I think people, even though it's backed by a basket of currencies, the ability to control what is in that basket is the problem. And one of the things that you always have to remember in all of this is that the big battle globally in terms of money is around what is considered to be the global reference currency. What do people, what they call the reserve currency globally. And today it's the US dollar. And I think in particular, the US government is very wary of losing control of the global reserve currency, because that has massive implications for its ability to do fiscal stimulus and issue debt and and do some of the things that it's been doing recently. So the stakes are very, very high. So I see these sorts of consortium entities having significantly more pressure against them to become successful, because of this inherent opposition that they'll see from central banks around the world. So I think those are kind of the two sides of the coin, so to speak.
True, absolutely. Thank you so much. So I have another query for you, Udayan, from one of the participants. What would be the impact of CBDC on international payment systems like SWIFT? And maybe you can add Ripple to that.
Yeah, look, Ripple is, let's take Ripple out for a second. Massive impact on SWIFT because you don't need it. You don't need SWIFT. SWIFT is essentially infrastructure for correspondent banking networks that rely on, let's say, dollar clearing through the Fed, because most of the volume, I think, is actually dollars. Of course, there are other currencies, but I think the majority of the volume going through SWIFT is dollar clearing. And so I think that it has a massive impact because you don't need that anymore. And that's part of the frictional cost we're taking, the friction that we're taking out and the cost we're taking out by moving into a CBDC type infrastructure. So I think a Ripple is a bit different. Ripple is using blockchain technology to allow you to replace SWIFT and to actually move fiat currencies, but using blockchain technology. So in fact, it's a competing network to SWIFT to be able to move money around. So it's a kind of intermediate step between a proper CBDC and a fiat currency that hasn't quite gone the CBDC route, by creating an interchange layer into blockchain. And so that's what that's creating. That's how that's creating efficiencies.
Okay, yeah. So I hope you got the answer. Yeah. So SWIFT is likely to have an impact. So, so does it mean that from the discussion that we've had, is there the possibilities are two, that one, each country has perhaps dual currency, one the normal fiat currency as well as the digital currency. Uh, is that possible? Is that possible? And what is the impact if you have such two currencies, which looks, at least in the initial time, for a large population, which is perhaps undereducated? How do they deal with digital money, where even the basic financial mainstream is just about touching them?
There's no impact. I talked about this earlier. So China is launching the currency. Most people won't even know it's there. Most people won't even know when they use it, because it's all about form factor. So it's 1 renminbi here, whether it's
Yeah.
held as a coin, or it's 1 renminbi sitting in your bank account as a traditional digital currency, or it's 1 renminbi being held in this new form of digital currency. And you'll pay for it and you won't even know. So this is form factor. As long as as long as you're not creating an entirely new currency, which has an exchange ratio which is different to your existing currency. So the concept of stablecoin, as long as you're backing one to the other, then there's absolutely no impact. The people who have access to the technology will embrace it and use the new version of it. The people who don't have access will use the intermediate version, which is traditional digital. People who don't even have access to that will continue to use cash. You'll have all three. I mean, I think the concept of cash going away anytime soon in most economies we're still quite a while away. This is going to take time. So there will always be people who prefer to transact in cash. There will be people who will transact in the traditional infrastructure, correspondent banking. There are people who want to use the new infrastructure. So really, it has no impact.
Right. Yeah. So the question is, like you have euro across the different countries in Eurozone, can't we have a single digital currency worldwide? Will that not be much more easier and much more governance possible on that?
Well, that's what Libra is trying to do, but I come back to the big problem with that. The big problem with that is who governs that currency, who is the, in inverted commas, central bank around that currency, who is relinquishing. Will the United States relinquish their current situation as being the global reserve currency? This is very political. The euro itself was very political. I mean, for those of you who remember, when the euro came in, it was a very, very highly political issue, because it meant that individual countries ceded monetary policy to the ECB, to the European Central Bank. And that's the UK, for example. Norway, didn't want to do that, so they maintained their currencies because they didn't want to cede monetary control to the European Central Bank. And it's exactly the same. So yes, theoretically, it's absolutely possible to have a global digital currency, which is a CBDC type currency. Absolutely. But who is the C in the CBDC, right? Which country is it, or which group of countries is it, and why is it that group of countries? Of course, if we could get all the central banks in the world to get together, like in the United Nations, and agree amongst themselves on something, then we could make it work. But where's the likelihood of that happening? Keep in mind that the United States uses dollar clearing as a very strong political weapon, because the ability for them to create sanctions against people like Iran rely on their ability to control the global reserve currency. So, these are very political, these are very political issues.
Yeah, that's true. Yeah. So let's, we spoke in detail about cryptocurrencies. We also spoke in detail about CBDC. With the adoption of CBDC, which looks like more under the control of the government or the central bank of that country, will currencies collapse or cease to exist?
Will the traditional cryptocurrencies
Will cryptocurrencies cease to exist?
No, I don't think so. I think people will still want to have still want to play around with currencies that no central bank has any control over. Because remember, CBDCs are controlled by a particular central bank, each one, like the Chinese one. So people will still want it in the same way that gold is a very viable storage of value today globally, right? Or real estate is a very viable storage place to store value today. So I think people they'll still be. Now, whether it'll become mainstream or stay niche is more a question of who recognizes them and how many how many central banks will allow them to be used in markets to buy goods, etc. But broadly, it'll be the same. Sorry, KK, do we still have you? I just wanted to make sure.
Yeah, I'm there.
Okay, good. So let me pick up a question that I see on the chat.
Udayan,
somebody is asking, the greatest friction and lack of transparency in the field of cross-border related currency needs, especially at the retail level. No customer realizes the underlying rate and the markup. Hence, isn't that absolutely? That is absolutely, and that's from Harish. That is absolutely a area for disruption. When you asked me earlier, KK, where do I see the impact on which sectors? As I said, travel is clearly one of the biggest sectors where you see an impact for this reason. It's actually travel and remittances, right? Both the same thing for the same reason. Because of the transparency on the underlying rates is one. And secondly, of course, the frictional cost of moving this money from country to country. Absolutely, there'd be a significant impact here. So yeah.
Okay, that's that's nice. Thanks, Udayan. So we come to one very important thing that has developed and has happened to say that yes, digital currency is here to come. It's coming. If not right now, it's coming in the days in the very short this thing, and that is the acceptance. A new consortium of global consortium for digital currency was announced at the World Economic Forum in January. Okay. The consortium has thus been tasked with designing a framework for the governance of digital currencies, including stablecoins, and includes public-private cooperation across developed and high-growth markets. So it's like, all-inclusive. It's not the domain of one country. It's like they formed a consortium which will also look at just not the public, but also the private, that is the government and the private enterprises, also countries which are developed and underdeveloped countries. I think this is a great move on the consortium. Udayan, your thoughts on this? Isn't it a great recognition of the fact that digital currency are here to come?
It's of course it's a move, and I think the central banks recognize globally that this is something that they need to consider and ultimately embrace, because you have to embrace new technology, especially if it has significant beneficial effects for people, which these technologies do. Now, keep in mind that if you read the WEF communication regarding this consortium for currency governance, there's a very, very striking omission in terms of people at the table. You have the governor of the South African Reserve Bank. You have the Central Bank of Kenya. You have the Bank of England. You have the Monetary Authority of Singapore. You have the Inter-American Development Bank. You have the Egyptian finance minister. You have the governor of Bahrain, which is a very small country, right? You have a few other people. You have David Marcus, who runs, Libra, who runs the Facebook consortium Libra. Of course, guess who's missing? It's the United States. You don't see the Fed at the table there. So this again comes back to, of course, they will all embrace it, but the big elephant in the room here, which is the Fed, isn't going to embrace this easily anytime soon for the reasons that we talked about, right? There's too much at stake globally in terms of what becomes the global reserve currency. And until you have the Fed embracing it, you're not going to create a global standard for this. You are bit by bit. What essentially the forum is trying to do is to design just a policy framework for the adoption of digital currencies. So they're just agreeing on how a certain framework that allows them to adopt. It's not the adoption of the currencies themselves that's being discussed here. It is a governance framework, a little bit like how many board directors should you have in a company, and what should the makeup of those board directors be, and what decisions should those board members be able to make versus shareholder decisions. That's what they're basically going to discuss in terms of governance. I mean, I'm not seeing this as a earth-shattering move that's going to change the world,
Okay.
so to speak.
Oh, okay. Yeah, I thought since most of the countries have come together, this could be a good move. But as you say, the big elephant is missing. So I do not know the importance of this. So we'll see as the days come. A question to you once again, which says, what are your thoughts on which central banks across most digital savvy countries can they form a common digital currency, which possibly may happen anytime sooner? I think you did talk about it a little bit.
Yeah, I already talked about that. So yeah.
Yeah, so I think we could do that. Let's look at another aspect of, another aspect regarding banking and technology. Should we really stop thinking about banks and technology companies? Because it is said money is now inseparable from technology. What are your thoughts there? Because money, it seems, is part of the entire technology framework that is coming up in future.
Yeah, I mean, there's no such thing as physical money anymore, right?
Yes.
Of course, there is physical money, but physical money is a minority globally of, if you think of global trade and cash and monetary flows, it's all digital, and anything that's digital requires underlying technology. So by its
Right.
nature, that's how we're architected. It's a little bit like somebody saying to me, which sometimes had this, you're a fintech investor. And I was like, well, yeah, of course we are fintech investors, but actually no, we're financial services investors. And they're like, hang on, wait a minute, what do you mean? I said, I wouldn't be investing in any company in the financial services space that didn't have technology, because technology is the biggest enabler of most companies, of all companies in the financial services. The age of using the abacus to tally up what's in your bank account, really is relegated to ancient China. We are in a very different world. So actually, technology is incredibly important in the whole financial service ecosystem, and it's actually the underlying. So I think people misuse fintech with fintech and financial services, kind of the same thing. There's no
Yes.
financial services without technology.
Absolutely. Yeah. I have another query for you there. So question is, do banks run the risk of becoming utilities with low brand awareness, little differentiation, and diminished customer loyalty?
Yeah, I mean, you call it a risk. I call it an evolution. I think banks will become utilities. I think the way you need to look at the banking sector is the way you should look at you looked at the mobile phone companies 20 years ago. Mobile phone companies 20 years ago used to own their customer. They controlled what data went down to the customer. There was no interoperability or number portability between networks. So there was a real sense of customer ownership, and the price points were very high. The ARPUs were very high. That's because they had the ability to do that. Now, on the other hand, you have uh, you know banks who were pretty much in that same space because they were fully vertically integrated in providing services to customers. As we stratify financial services, we've talked about this previously with open banking and new standards and the data interoperability, the ability to data. It's a little bit like number portability. You have these things that start to change. I would say mobile phone companies today are dumb pipes, what we call dumb pipes. They are the carriers of data. They're the carriers of information. They become a utility to move information from A to B through those pipes. And as a result, they have to charge utility like pricing. And banks will become exactly the same. Banks will become repositories of value, regulated repositories of value, and they'll be able to charge a certain amount of money for the risk management that they're able to do as a repository of value. So I think that is the way you need to think about the evolution of banks. And there will be, of course, some specialist banks, like specialist mortgage banks and a specialist bank that does maybe just crypto, that will obviously have customer relationships and just focus on very niche. But the big ones with big balance sheets will become utilities, just like the large telcos have become, and they will become very commoditized in what they provide. I completely see.
Okay. So would that, like you said, we every country, when digital currencies are introduced, it will have two types of currencies. One is the current fiat money, and the other is the digital currency that is there. So will banks hold both these currencies, or the digital currency will be held by a fintech or somebody else?
No, the banks will. The banks will have the infrastructure to hold both currencies. I mean, they have to, right? It's just an incremental new bit of technology that they're adding to their arsenal. So banks will do both, and over time they'll probably phase out the old one and move completely to the new one, and we'll close down. And by the way, that's no different to what we see in the telco market. We started with 2G. Actually, we started with 1G. We don't even remember, right? 1G, which was analog.
Yeah.
Then we went to 2G, and then from 2G we went to 3G. From 3G we're now pretty much across the world on 4G, and we're now rapidly moving into 5G. All we're doing is that the form factor is the same. We're talking on our phones, we're using data. Nothing's changed there. What's changing is the underlying technology. And by moving to 5G, we have much greater bandwidth at cheaper cost, and we're able to just do more of it, at much less. This is exactly the same thing. There's no difference here.
Okay, very true. So that's good to hear. So, ladies and gentlemen, if you're thinking, where is going to be my digital currency going to be stored? Because today, most people still trust the bank. So your currency will be held by the bank, as per what Udayan says. You will have the normal currency held by the bank. You will have the digital currency also held by the bank. So you have the trust factor that is very much required when you hold the public money. So that's a good news for everyone. So one of the questions that I want to ask you, Udayan, is that Mark Zuckerberg wanted to introduce Libra, for use across Facebook, WhatsApp, and Instagram. And that would have been a kind of maybe a path-breaking initiative if you could do that. So what's the advantage? What's the business strategy for doing this across these three social media channels?
It's adoption. So basically, the key thing about Facebook's foray with Libra has been about adoption, because they have so many billions of users globally, right? If you can get 1 billion users to use something very, very, very quickly, it becomes a de facto standard that people will start to use. A little bit like WhatsApp has become ubiquitous across the world because of adoption. So that's the advantage. It's the network effect of adoption that Facebook was trying to push, but obviously with significant opposition from regulators because of the inability to control that particular currency.
Right. Excellent. Thank you, Udayan. I think we've come to the end of our session. And I think, ladies and gentlemen, we had a lot of discussion on the future of money. We had discussions on the form factor, friction of money, which I think Udayan really brought it out, and the cost related to that, and the disappearance of friction once a digital currency comes into being, which is thought-provoking. It's something new that we should look upon. We talked a lot about cryptocurrency and blockchain. I would leave, ladies and gentlemen, this thought that money is data. In the future, money is data with a wider range of values and characteristics. Money will become invisible, instant, and inclusive. Data will change the way we think about and interact with money. Data will bring vast segments of the population out of the shadows of banking in the near future. So that's the thought I would leave with you. Udayan, once again, wonderful talking to you. So many insights into the future of money. Thank you, and hope to see you once again in the very near future. Thanks a lot.
Thank you very much. Good to see you. Thank you.
Thank you. Bye-bye.